What is the statistical discrepancy in national income accounting? Imagine trying to measure the total size of a giant puzzle with millions of pieces. Sometimes, the pieces don't fit perfectly, and you need a small adjustment to make everything match. That adjustment is what we call the statistical discrepancy in national income accounting. It's a way to balance two different ways of measuring the economy's total output. One way to measure gross domestic product, or GDP, is by adding up all the incomes earned in the country. This includes wages, rents, interest, and profits. We call this the income approach. The other way is by adding up all the money spent on final goods and services. This is known as the expenditure approach. In theory, both methods should give the same number, but in practice, they often don't. The reason for this difference is that collecting economic data is very complex. There are mistakes, delays, and estimation errors. Sometimes, data from different sources don't line up perfectly. For example, some transactions might be double-counted or missed altogether. Prices used to convert values into real terms might also vary, causing small differences. To fix this, statisticians include the statistical discrepancy as a balancing figure. It's like a small correction to make sure the total GDP from the income approach matches the total from the expenditure approach. Usually, this discrepancy is very small, often less than 1% of the total GDP. That shows the overall data is quite accurate, even if not perfect. Understanding this discrepancy helps policymakers and economists see the limits of the data they use. It also encourages improvements in how economic data is collected and processed. When the statistical discrepancy is reported, it shows transparency and honesty about the challenges in measuring a complex economy. In short, the statistical discrepancy in national income accounting is a necessary adjustment that makes sure the two main ways of measuring the economy's size agree. It reflects the difficulties in capturing every single economic activity accurately and reminds us that even the best data has some margin of error.